The Bank of Canada has just released its monetary policy report for April 2020. Now, this is the first report the Bank of Canada has come out with since their last report before the COVID-19 pandemic really hit the global markets and breached across Europe and over into North America. So let's dive into what the Bank of Canada report is telling us and our interpretation of it. First of all, they stated that in their summary report of this report, they said, while the global and Canadian economies are expected to rebound once the medical emergency ends, the timing and strength of the recovery will depend heavily on how the pandemic unfolds and what measures are required to contain it. The recovery will also depend on how households and businesses behave in response. And of course, they've stated, and this is an obvious one, but none of these can be forecast with any degree of confidence or certainty. So in the current environment, decisive and timely policy actions as well as clear communications are critical. Now, that was the beginning of their summary report. Before we dive into further details, I'm just going to highlight a few other sentences that I caught my attention. One of them was that credit conditions are likely to remain strained for some time due to heightened uncertainty and concerns over the credit crisis. And finally, that given the rapid evolving situation and the high degree of uncertainty, the Bank of Canada has departed from its usual format for the monetary policy report. In short, they, like everybody else, doesn't know what's happening, don't know what's going to happen, and so I think they're just trying to provide the market with some kind of confidence that at least they're still showing up to work. The final point that they make is that given the uncertainty surrounding the outlook, the Bank of Canada has decided not to present a base case projection in this report. So what they've also basically said, what that means in layman's terms, is they're not going to use any models like they've been using in previous reports because all those models are basically been thrown out the window. The regular April updates for estimates of potential output and growth and their neutral nominal policy rate are deferred until October of 2020. Now you ask yourself, why October of 2020? Of course, there's another report coming out in June. This is when Stephen Pula is expected to have his last announcement as he departs as the Bank of Canada governor. So it seems to me like he's leaving this for someone else to pick up in the fall. The first section of their report talks about the global economy. Specifically, they make reference to supply chain. They state that sharp fall in trade has prompted major disruptions in supply chains. And as you can see here on chart 1, the Purchasing Managers Index, there's a massive drop globally in the supply chain channels. And this is something that I think a lot of people haven't necessarily thought about yet, but think about your own consumption activity. We know there's maybe a short supply of toilet paper right now, but when you go back to work, when people go back to work and they plan to go to the store to buy some bigger ticket items, whether it's televisions or automobiles, those factories have been shut down. They've been shut down for weeks, if not months. And the startup for those factories is going to be very slow as well. So I anticipate this supply chain issue to be a bigger story as months unfold than maybe the Bank of Canada is alluding to. In the goods producing sectors, production lines will likely operate below capacity for some time due to disruptions in supply chains. It's another statement made by the Bank of Canada. And then they jump into the global financial system that's under extreme stress. So they state that the prospect of severe contraction in global growth has led investors to sell risky assets and purchase only the safest financial products to increase cash buffers. Now, I can speak to this anecdotally as running the head of the cash management group, managing nearly $3 billion of institutional cash. There has been an absolute massive flight to safety. We've seen clients, and we've advised many of our institutional clients to allocate part of their portfolio to things like treasury bills, and that's effectively what the Bank of Canada is alluding to. And those people who are going into treasury bills, especially the big money managers, what are they selling for that? They're selling equities, bonds, commercial paper, and other lower quality, higher risk type fixed income instruments. To paraphrase the Bank of Canada report, the search for safer assets has resulted in the appreciation of the US dollar against the Canadian dollar. A fall in commodity prices has also contributed to the depreciation of the Canadian dollar. The Canadian dollar has come under a ton of pressure recently. So I guess fortunately for Canadians, we can't travel to the United States yet, but when we do, it's going to cost us a lot more. In continuing, chart 3 on the report talks about credit spreads versus U.S. Treasuries. Now this is of course U.S. data, but it highlights what's going also on here in Canada. Specifically, the item I want you to look at on this chart is the red line. Now this is a high yield, non-energy index spread on U.S. bonds. So these are corporations that are non-energy related and what their interest rates are on their bonds versus U.S. Treasuries or U.S. bonds. And they're, at one point they got over to 800 basis points. That's 8.00% above Treasuries. This is unheard of. We have not seen bonds with this kind of spread since the financial crisis. And this gives you a sense of how much risk the market perceives in the fixed income or the bond market today. This is very important, and we'll talk about that a little bit later. Finally, on the oil front, Western Canadian Select, or WCS oil, which is the oil reference price for our folks and friends in Alberta who are selling oil, have declined by 90%. In fact, I saw recently that some prices were selling off to down as low as $8 a barrel. I talked about that last week, and this is something that's absolutely terrible for the Alberta economy. I mean, they're dealing, like I said before, dealing with a crisis on top of a crisis. And finally, chart 4 on this report shows you commodity prices. You've got forestry products, you have base metals, and oil prices all declining significantly. The next section on the Bank of Canada report is the Canadian economy, and they start off by saying this: economic activity overall was relatively on solid footing. That underlying resilience will help support the Canadian economy through this difficult period and subsequent recovery. I think this is being far too optimistic, and I actually don't believe that in this statement. I think that it doesn't actually really matter what the economy looked like, what the financial position of individuals and corporations looked like before. That's all out the window. And what I find strange with this report is how they can agree that there's so much uncertainty that they can't actually predict much, yet this is something they can make a claim on. They state that Canada's economy now faces 2 significant and related shocks: COVID-19 pandemic and then the plunge in global oil prices. They also pointed out the jobs numbers that we spoke about earlier this week. In March, more than 1 million jobs were lost in Canada. 1 million. Here in British Columbia, it was 133,000 jobs lost in the month of March. But the other number that a lot of people haven't been talking about is the amount of people who are still working, but they're earning a lower income. Hourly employees who are now being given less hours to work. That number came in March at 2 million. 2 million working Canadians who now have fewer and in some cases no hours at all. So they haven't technically been laid off, but they're not being given any hours. Chart 7 illustrates the total dollar value of Interact debit transactions and how much that's dropped as people have been not just self-isolating and that businesses have been shut down, but people are self-quarantining. And so we can see those transactions have really dropped. And of course, this probably gives you a good reflection of how much the transaction activity has declined for some of the big credit card companies like MasterCard, American Express, and Visa as well. They also state the Bank of Canada's numerous and timely actions to increase liquidity are aimed at helping to keep lending channels open. Well, that's a fair and true fact. I don't know how well that's going to work out into the future, but let's talk about what they see as their scenario analysis. So they state that their scenario analysis is estimating that in the first quarter, GDP is going to drop by 1 to 3%. So that's from January 1st to March 31st of 2020. And then they're estimating a 15 to 30% decline in the second quarter of 2020. This is, of course, compared to the fourth quarter of 2019. This is an astonishing number. To even suggest that we get to 15% decline, never mind a 30% decline, I think has far bigger impact than most people can appreciate today. Despite a high level of uncertainty, these estimates suggest that the near downturn will be the sharpest on record. The Bank of Canada continues to highlight that the COVID-19 will weigh heavily on consumer price index as well. That makes sense. If people aren't buying and producers are barely producing, but there's really virtually no buying activity going on, prices generally don't rise. So inflation in the coming months is expected to drop by the second quarter to 0 inflation. Payment and tax deferrals will leave more than $120 billion in the hands of households and businesses. To paraphrase the Bank of Canada's statement, as a result of the Canada Emergency Wage Subsidy Program, some businesses may be able to stay open with workers maintaining relationships with their employers. Now, what the heck that means, I have no idea. It sounds really warm and fuzzy, but I have a much more negative view on this. I actually think that a lot of employers are going to probably be laying off their employees in 3 to 4 months after the 75% wage subsidy program stops, unless the Canadian government continues it on, because these employers are going to simply look at their balance sheets, they're going to look at their cash flow, and if they've not recovered enough to make a profit, they're going to start laying people off. So I actually think this program, the Canadian Emergency Wage Subsidy Program, has been goofed up by the federal government. They went from being originally offering a 25% wage subsidy to a 75% wage subsidy. I'm sure there's a lot of business people aren't going to approve of what I'm saying, but the problem is, it's just kicking the can down the road, in my opinion. And at some point, this cost is going to be embedded back into the taxpayer's own pocketbook. The Bank of Canada also announced, of course, that they cut interest rates by 150 basis points, or 1.5% in the month of March, the biggest cut we've ever seen. Table 1 of the report highlights the fiscal policy for support to both households and businesses by the Government of Canada. I don't even really know why this is in the report. This has really nothing to do with the Bank of Canada, but maybe they put this in here to try and make the report seem a little more interesting to read. So let's go through the list, because it's a long list. Now, this is what Justin Trudeau has been promoting over the last couple of months, so let's see what he's come up with. First of all, there's the increase in the Canada Child Benefit for 2019 and 2020. There's the paid one-time enhanced goods and services tax credit. There's the introduction of the Canada Emergency Response Benefit and the Indigenous Community Support Fund. There's the launch of the Canadian Emergency Business Account. There's the introduction of the Canada Emergency Wage Subsidy, the extended maximum duration for work sharing program, the establishment of the Business Credit Availability Program through the Business Development Bank of Canada and Export Development Canada, increased lending capacity for Farm Credit Canada, deferred business and personal income tax payments. Look, this is the list. We won't carry on. In my opinion, there are a ton of programs. Obviously, I would encourage business owners and individuals to take advantage of these programs. But one of the things a lot of Canadians have need to think about is who's going to pay for all this? And how long can these programs go on for? This is why I think this Bank of Canada report doesn't really highlight how negative things can get for our economy. The Bank of Canada carries on with this report by detailing their support for the economy and the financial system by, for example, their monetary policy of lowering interest rates by 150 basis points down to 0.25%. It wasn't a surprise today that the Bank of Canada did not cut interest rates, but because how much lower can they go before we get into negative interest rates? They also support the function of the financial markets by launching the Bankers Acceptance Purchase Facility. They introduced the program to purchase Canada mortgage bonds in the secondary market. They also introduced a provincial money market purchase program. Effectively, what they're going to do is start buying provincial treasuries. Okay. And the part that I find amazing is their commercial paper purchase program. So the Bank of Canada, to the best of my knowledge, for the first time in their history, is now going to start buying commercial paper in the secondary market. Very unheard of. They've launched a program to purchase Government of Canada securities in the secondary market with a minimum purchase of $5 billion per week across the yield curve. We are seeing yields going down in Canada. Rates are going lower, and this is why I've been pounding the table for months, even before this whole COVID-19 crisis came about, saying buy yourself some comfort, get your money into longer terms where you can, when you can. They've also announced the enhanced term repo operations and activated the contingent term repo facility. I think this next part of the report was written by Captain Obvious. As restrictions are lifted, the economy will recover. Well, that's a pretty obvious statement. They state that non-essential businesses will reopen and will recall workers at a brisk pace. I don't know where they come up with the idea that workers are going to be hired at a brisk pace. They state that fiscal policy should help prevent a long-lasting decline in business and consumer confidence. The business confidence is expected to strengthen as demand picks up and many firms reactivate their investing and hiring plans. I mean, this is all very optimistic, and of course, I hope this is what's going to happen, but I really don't understand, and this is where the Bank of Canada really deviates from their original comment in the overview of where they can't really predict where things are going. They've thrown out all their models, yet somehow they can predict that we'll be seeing employees hired back at a brisk pace. Maybe it will, maybe it won't. I'm going to make the statement right now that I don't know, and neither does Bank of Canada. The housing market will benefit from a rebound in household income and low borrowing costs. Well, maybe, but if people are losing their jobs and not employed, I'd make a counter argument to that. And finally, they also make a reference to the rebound is going to be supported by the ongoing access to credit provided by to Canadian companies and households through the resilient Canadian financial system. Now, this doesn't sound biased to you. I don't know what does, which also highlights their big banks that are going to help support this. They also state that the stress test will indicate that Canada's large lenders are well positioned to weather a severe and economic financial downturn. Doesn't that sound nice? I went and looked at the stress test data and the modeling, which was produced in March of 2019. I don't think the stress test took into consideration a COVID-19 global pandemic. They also state the uncertainty and scarring effects of a recession on the confidence and the production capacity could prolong the recovery substantially. That's a nice fluffy end to that part of the report. Let's move on. They next state the outlook for the Canadian economic activity is highly uncertain. Well, that again is quite obvious. So they decide to, instead of provide an outlook, they're going to provide two scenarios. I provided three scenarios in our previous video. Here's the two scenarios that the Bank of Canada is providing. Scenario one is where containment measures are relaxed soon and policy measures successfully limit any potential structural damage to the economy. Foreign demand would come back relatively quickly and global supply chains would be up and running in short order. Consumer and business confidence would recover, providing additional boost to growth. Overall, in this less severe and less persistent scenario, the decline in economic activity is abrupt and deep, but relatively short-lived. Sounds nice to me. Let's hope that that happens. I don't think so. Chart 10 talks about the industries most affected by COVID-19. Now look at this chart. This is fascinating. Take a look at the accommodation and food line at the top of this graph. These are businesses that are going to take a long time to recover, and many of them are going to go out of business. So let's dive in scenario two. To me, scenario two is the much more realistic scenario. They basically state that they consider the impact of household and businesses could be more severe and much more persistent. This could lead to a significant number of businesses to permanently close their doors and going through a bankruptcy process. Production value of plant and equipment could largely be gone, and workers who are let go may need to move to different industries to relocate. These effects could cause structural damage to the economy that might not be undone for years, if ever at all. Prolonged downturn would also mean that households, businesses, and governments could be more indebted by the time the recovery takes hold. Well, this is a very true statement, folks. Again, think about the amount of money the government is producing right now. You can't just print money like this government is doing right now and offer these types of programs without some kind of cost later on down the road. Don't forget what happened after the financial crisis of 2008, 2009. The most common word amongst politicians and policymakers at the time was austerity. Austerity measures was the most common theme, and it's actually what ended up driving a lot of governments out of place as they carried on with austerity measures for too long. Just think about what happened and remember what happened in Greece. They also state in scenario two that credit markets may be impaired and slow to recover. I think that's a very nice way of saying something that could be far, far worse. The last part of the report, of course, is the one that the Bank of Canada seems to always got to have a reference to, and that's inflation. I know inflation is important, but look, this is not the 1980s, and the people who are running the Bank of Canada and the other banks are generally older than myself. I'm 45 years old, and I was an adult during that time, so I didn't have to feel the pinch of high inflation prices and high mortgage prices. So I don't know if the central banks will ever give up this theme of focusing so much on inflation until the older folks that are running those central banks go off to retirement. But let me tell you this, the Bank of Canada thinks that inflation is going to go to zero for the second quarter of 2020. They state that on the downside there's a risk that supply recovers more quickly than demand. What does that mean? It means basically that businesses reopen quickly, start producing goods and services, but consumers remain cautious and don't spend as quickly. And they state that this downside risk of inflation is likely much larger than the risk of upside inflation. The next Bank of Canada Monetary Policy Report will come out on July 15th. It's going to be very fascinating to see how all of this unfolds between now, April, and July 15th, and what that report shows for us. In parting words, I want to say this to the people who are listening. If you're a business owner, if you're an employee, whether you've lost your job or you haven't, take a look at your own financial house, put it in order. If you're a high spender, stop the spending. This situation could get very bad. There's nothing wrong, there's nothing bad that can come from pulling back, reining back your spending activity today, and investing wisely. Be sure with your portfolio. Make sure you got a plan. My team, of course, is available to help you out if you want to talk about, generally speaking, financial planning activity, or you want to talk about your specific investment portfolio. Whether you're a high net worth investor or you're an institutional investor, we're happy to speak with you. Thanks very much. We'll talk to you soon.